With long-term horizons, you should take aggressive steps to diversify and reduce risk in your portfolio. But those closer to retirement should also be careful. For retirees or near retirees, it may be time to shift into preserving your assets rather than trying to play catch-up. David Potter, former spokesperson for MassMutual Financial, says people are investing for the wrong reasons. Many people may be taking on too much risk in their portfolios and not considering what will happen during a market downturn. Potter suggests that investors continually reassess their portfolios to be aware of how they would fare if the market plunged. Luckily for you, Fortune Fastlaner, we've produced a list of the safest investments for your 401k. Remember that while the first step is completing any of these amazing videos, the second and possibly more important step is taking action, even if it's an imperfect action. Many people never pay attention to their 401k account because they don't know how much the 3-year average annual return is on their investments. But saving into your 401k is some of your most valuable investments. It's good to review your investments, especially as you get older and have to save more money. Allowing even small percentages of these savings to slip away is not worth it when a few $100s can make all the difference in retirement. Contributing to 401k is important for the value of your retirement account by leaving your funds invested in an employer-sponsored retirement account until you reach the age of 59 and a half. You'll see longer-lasting investments with a greater return on investment. You can invest in stocks, mutual funds, and other volatile investments. Some people opt to take on high risks with the hope of reaping larger returns. Others may prefer to maintain a more conservative investment strategy and secure their 401k return. By design, investing carries with it the risk of losing money, but some 401k investments remain relatively stable over varying time frames, while others fluctuate significantly. You can judge the quality of a fund by its expenses ratio and average yearly performance. The expense ratio is an annual percentage that your fund takes from your assets. Number 1. S&P 500 Index Fund. An S&P 500 index fund provides investors with investment access to 500 of the highest performing U.S. companies in many different industries, as many as 76% of the total share values. Since the Vanguard 500 Index Investor Shares closed its doors to new investors, Fidelity's S&P 500 Index Fund is your next best choice in the S&P 500 category. The fund is a 32-year-old fund that operates within the Morningstar Large Bend category. This category consists of portfolios that reflect the overall stock market in size, price, and growth rates. The fund has a consistently higher AAR ratio than the Large Bend standard. FXAIX has a low expense ratio. This fund holds the top spot for underlying net assets in the S&P funds. Number 2. Vanguard Total Stock Market Index Fund Admiral Shares. Vanguard's Total Market Fund provides a low-cost opportunity for broad individual interest in the entire U.S. stock market. It includes small, mid, and large cap value and growth stocks, as well as an impressively low expense ratio that makes it very attractive to 401k participants. This fund has posted a 10-year average annualized return. If you are willing to accept the risk that is inherent with stock market investing, this fund could be worth looking into. A look at the 2020 VTSAX data by year can let you know if this fund is for you. Number 3. Federal Advisor Technology Fund. FADTX, a sector fund that has attracted investors for the past 10 years, invests in U.S. tech companies and has generated high returns. In 2020, FADTX posted a 77.38% return. This fund concentrates on technology companies like Microsoft, Visa, and Apple. FADTX has an expensive cost-to-income ratio and a low net asset balance, but they have a 10-year AAR ranking of mid-tier grade. They've scored the highest grade of 5 on the YTD Lipper rating. As sector stocks generally lag other investments, FADTX would make a strong complement to your core holdings in your 401k. Number 4. Bond Funds. Bond funds are a type of pooled investment that allows you to invest in debt securities. Bond funds can focus on specific types of bonds, such as government bonds. There is a wide variety of risks when it comes to investing in different types of bond funds, but among them, mutual funds tend to be thought of as a safer alternative than stock mutual funds. Bonds such as Treasury inflation-protected securities are considered one of the safest investments, because investors will receive either the original or the adjusted principal. Even if you have lost money in your investment, there is no chance to lose more than invested. There's not too much potential with this type of bond exposure, given below market return. Number 5. Money market funds. Money market funds reduce the risk of low returns, as they are meant to be stable and offer a high level of liquidity. Like bond funds, money market funds invest in debt securities. Money market funds are grouped into 3 categories: government, prime, or municipal investments. Similar to other lower-risk investments, the returns on money market funds tend to be lower. As an investment, money market funds tend to be at lower risk, but these investments are not insured by the Federal Deposit Insurance Corporation. Number 6. Index funds. An index fund is a type of mutual fund that invests in broad market exposure. While an index fund tracks the performance of one particular benchmark, exchange-traded funds, sometimes found in 401k lineups, aim to offer passive investments with higher returns. Index funds are considered to be a long-term investment strategy. Unlike mutual funds that are less prone to stock market fluctuations, index funds introduce diversification to your 401k while keeping in mind the risks associated with these investments. Number 7. Stable funds. Stable value funds are an investment that provides higher yields and is also a safe option when the market becomes unstable. With these bond portfolios, you will not lose money, even if the economy is at risk. Approved price insurance comes with this type of portfolio, which means you'll earn interest on top of your investments, even if the economy falls short during a recession. When you choose a stable value fund, you know the investment principal will be used for investment returns. When that's the case, your possible returns will be lower than that of other options. Number 8. Target date funds. Target date funds are mutual funds that move towards more conservative investments as you get closer to your chosen retirement date. The target date funds move towards more conservative stocks and bonds, favoring those with lower risk over those with higher risk. It's easy to establish a target date fund or retirement fund. If you choose to go with a target date fund, it will reach its most conservative investment approach after you've reached your retirement date. If you opt to have the fund go through retirement, it will adjust levels of risk until your agreed upon age. Generally, financial professionals recommend that retirement savers dial back to their exposure to stocks as they get within 5 years of retirement or within the 5 years after retiring. For example, if you retire at the age 65 and the markets lose 20% or more in a single year over those 5 years, your income could reduce to an irreversible extent. How to choose the best investment for your 401k. Employer-sponsored 401k plans are one of the best benefits available to employees, because the money you contribute is deducted from your gross income before taxes. You don't have to pay taxes on the money you put in. The principal within the fund continues to grow on a tax-deferred basis until you receive distributions. And many employers contribute extra funds to your contribution, which some term free money. Some employers contribute up to 6% of an employee's salary on a dollar-for-dollar basis, up to the amount of the employee's contribution. If you make $50,000 per year and set aside 10% of your salary into your 401k, in this scenario, your employer would contribute an additional $3,000, increasing your total investment to $8,000. This is a major benefit that substantially accelerates capital growth. It is possible to save more for your retirement by investing for 20 years with a 5% return rate. If you invest $5,000 per year, your fund can reach up to $104,493 in a span of 20 years. if you earn a 5% return on your investment. Make sure to contribute the maximum amount allowed by any company's matching contributions by selecting investments that are in line with your retirement goals. When does it make sense to mitigate risk in a 401k? The value of your 401k will fluctuate throughout its lifetime. You can now choose to take minimal risk in order to reduce the potential for blowout losses near retirement by entering safer investments sooner. If you tend to be risk-averse, regardless of your timeline for retirement, you can invest a lower percentage of funds into more reliable investment options earlier on. Where to manage your 401k? Following your 401k portfolio carefully can maximize long-term returns. You should choose a provider who also provides the plan. The administrator performs the transactions, handles bookkeeping, and reports it to you and your employer. There are a number of ways to help manage 401k. Choosing an online brokerage is one way. It often provides educational material and tools for day trading. These are some of the most prominent brokers you should consider. Number 1. Facet Wealth. Facet Wealth connects you with a certified financial planner who will get to know you and create a custom financial plan in your specific circumstance. Instead of navigating the process independently, will be accessible to help you. Instead of paying commissions, you can use the Facet dashboards to see a snapshot of your finances without having to worry about your personal financial information. This enables you to keep your personal and financial information in one place for maximum security. Number 2. Bloom. Bloom provides personalized financial advice and simplifies your portfolio compared to other financial software. This platform is dedicated to changing the way you save before retirement. Connect your retirement accounts with Bloom's platform to get personalized, intelligent financial advice. Create an account in minutes and follow a plan that is specifically tailored for you after a question or two. When you sign with Bloom, you can choose from 3 tiers of personalized service. For standard and unlimited members, your investments will be continuously optimized and portfolio monitoring. You can also have access to funding research and expert financial advice. Number 3. TradeStation. There are 2 important areas to manage a portfolio: rebalancing and reallocating your investment. TradeStation offers easy tools to help you manage these functions, as well as introducing algorithmic trading strategies with a minimum of a $500 deposit. TradeStation has a mountain of historical data from which you can backtest your investment ideas. It also provides customizable charts and micro-marketing tools that make it easy to devise the best way to invest. Commit yourself to learn how to use TradeStation's powerful tools, and you'll be empowered with the best ways to invest. Seeking help from a financial advisor. Taking the time to do a little research and find a qualified investment manager or financial advisor can be useful in managing your 401k. According to an article published by the Financial Engines, professionally managed assets perform 3% better than non-professional managed assets. However, because many professional investment managers could charge up to 3%, it may not always be worth it. Smart Asset shows you how to find a safe, affordable, and tax-efficient way to find a professional 401k plan. More about Smart Asset. Smart Asset helps users make decisions when it comes to investing their money, since they can learn if a company is reputable without the arduous task of going through trial and error. Investors don't need to deal with con artists because data results are accurate due to the advanced software behind Smart Asset. Smart Asset offers personal financial tools to help individuals know what investment options they have. Its website has a wealth of resources that cover investing, as well as different kinds of advisor fees. It's possible to understand how an advisor fee structure works by exploring the pros and cons of a financial planner in computer-based services. You can use Smart Asset to help you manage your 401k with tools like 401k Calculator and a tool that automatically reviews your investment decisions. Looking for a robo-advisor? Use this tool to help find the best investments to fit your situation. Smart Assets online platform allows you to quickly filter out the website's recommended financial advisors. The site asks a simple question, which results in the best advisor options. All their information is displayed on the screen, and you don't have to deal with phone calls from multiple confused advisors. Making investing easy, Smart Asset reveals that its financial advisor database has Securities and Exchange Commission registration. The startup tags any advisors without serious securities violations and eliminates them from the list of potential options, which make investment decisions easier. How can you choose safer investments for your 401k? It is important to evaluate your risk tolerance and the time frame in which you want to retire. 401k plans typically offer a few options for investments, which may be suitable depending on your situation. Certain investments will have similar risk profiles, and their timelines will line up well with yours. Can you manage your 401k? It is important that you are diligent in managing your 401k. A casual approach to your 401k can lead to mixed outcomes. However, there are tools and resources available, like a 401k calculator for you to properly manage your investments. Can you view on risk change over time? 401k plans may have 8 to 12 investment options, and they come in a variety of roles, including equity, fixed income, government, and more. You can also make changes to your 401k investments to reflect your changing risk tolerance. Check with your employer or HR department to see how often you can make changes to your 401k investments. When you start thinking about saving for retirement, it's best to make sure that you're investing wisely. When you finally have the chance to retire and use that money, it will have a huge impact on how much money you will ultimately have available and how your tax bill might be. No investments are precisely the same, since everyone's risk appetite is different. Your 401k will be affected by market cycles over time, but sometimes investment choices will ensure more stability than others. If you prefer to play it safe, there are a number of lower risk investment options that you can explore for your 401k. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your fortune. Remember, you can watch video after video, but it isn't until you take action that you'll start to see results. See you on the next one.